this webinar. I think it's our 11th that we've done so far over the last year. And it's really a fundamental topic that we've been hoping for a while to cover. And we're really fortunate to have the MDIF team with us as the guinea pigs for this issue of tying fund manager returns to the impact outcomes of a fund. Um, we'll be exploring this issue from a couple of different angles and trying to keep it very concrete. I'm going to give a brief introduction now, and then Harlan and Evan will present their approach to the issue and what they're doing practically with respect to a new fund that MDIF is currently raising or launching. And let's look at it from the perspective first of the ways in which a traditional PE fund differs from an impact fund, right? You have, in a traditional PE context, you're seeking financial return, and accordingly, the carry is tied to that financial performance, right? The compensation besides the fees to the fund manager is directly tied to how well the fund itself does. From an impact PE fund, you're seeking both the financial and the social return. The carry, therefore, makes sense that it would be tied to both the financial and the social performance. This makes sense for a variety of reasons, but it's not generally necessarily the case. Or at least from our analysis of the industry, it actually seems to be a little bit of a minority position. And again, MDIF is at the forefront of developing things. I see a few reasons why it makes sense to tie the carry to the social returns as well as the financial ones. Part of it is this idea of skin in the game, of having the fund managers actually either benefit or have a detriment from not meeting what they committed to doing. There is a good function here in terms of aligning the interests of the LPs with the interest of the fund manager. As an LP, you go into this fund because you're trying to achieve certain social outcomes as well as getting your returns. And there's a way in which you can align those interests. And lastly, it's a way overall, both for LPs and for the fund manager, to protect the mission of the fund, right? You do want from the get-go and for the rest of the life of the fund to ensure that you're actually going to be doing what you said that you would be doing with it. There is an added bonus to it, I see, that is that it actually forces you in advance to define quite thoroughly what the impact thesis of the fund will be. You could, there are some instances where we've seen a somewhat vague impact thesis. And if you are going to be tying your returns to it, that gives you a pretty good incentive to be very clear about what it is that you're expecting in terms of the social returns there. Let's put it a little bit in the context of the work of Transform Finance and the work of this investor network. With respect to our principles around community engagement and accountability, non-extractiveness, and the fair allocation of risks and rewards, I think this issue, more than others, really hits on all three sides, right? This makes the fund overall accountable to the mission that it has set for itself. It is non-extractive in the sense that it reduces the opportunity for, in this case, the fund manager to actually derive benefit when the benefit for the community or for the ostensible beneficiary is not reached. And it does align more adequately and therefore provides a more fair allocation of the risks and the rewards for all the parties that are engaged, for all the stakeholders in this. Let's look briefly at an overview of how this has been done. You can do it in two principal ways, which is to tie the fees that the fund manager receives to the impact across the life of the fund. So there's more of a yearly analysis of the impact that it's achieved, or to the carry, right? At the end of the life of the fund, or when you have an exit, the amount of carry that the fund manager will receive will be dependent or contingent on the achievement of certain social outcomes. It can go up or it can go down. So it could be in terms of providing extra returns to the fund managers if they reach certain outcomes, or it could be down in the sense of actually docking from whatever the carry that was pre-established. Let's say you have a traditional 20% carry structure, and the fund manager could be exposed to receiving less in case this is not achieved. And lastly, on how that impact is evaluated, whether it's achieved or not, it could be an internal evaluation or an external evaluation against a certain metric or a certain benchmark, and or a mix of the two, where you have an internal, let's say, impact committee on the side of the fund that will make that determination, but generally will be based or predicated on some sort of external parameters. Looking at a couple of examples here. So in the abstract, yeah, you could have an incentive structure that is tied to the fees. There was one example I heard of from Deutsche Bank, where the annual fee would be increased by 50 basis points in case certain impact outcomes were achieved. So there would be a case that excuse me while I try to Can you? All right, great. Can everybody else still hear me?
Yeah.
Yes. Okay.
Yeah.
Great. All right. Let's hope that interference does not reappear. So okay, we're talking about the example of the fees of the impact reward being tied to the fees. In the case in which the impact is proven, the fees go up. In the Deutsche Bank example I mentioned, it would go from 2 to 250, and where it's established internally, it could be tied to the carry, and it could be going down. That is to say, you start with a carry of 20%. If you don't meet certain external impact criteria, your percentage of the carry goes down. Couple of examples. Vox Capital, based in Brazil, was one of the first funds, to my knowledge, that did this very seriously. We're fortunate to have Rebecca from Vox on the call with us. She might want to expand on that at some point. In the case of Vox, 50% of the carry is tied to the impact results, and those are measured through gears. So if the minimum gears rating that has been established before the investment period is not obtained, the carry is capped at 10% versus a 20% in case the carry is, in case the impact results that were pre-established have been reached. Gawa Capital, very exciting in the microfinance space as well. In their case, the carry would go from 15 to 20% based on an impact score that is a multiple going from 0 to 1. So one thing that is exciting about this structure is this, what I would call a dual function, right? The fund manager could pick to invest in ones, that is to say, the kind of portfolio entities or the kind of investments that are 100% in line with the impact thesis of the fund. Or it could be that the fund manager decides to pick somebody that would fall somewhere on the spectrum between 0 and 1, and the function of the fund manager, part of the additionality of the investment, would be to enhance those weaker plays, right? Try to get, let's say, somebody that is at 0.7 and bring them to 1 towards the life of the fund, which ties well with our last conversation a couple of weeks ago around the job quality work that the Huntington Capital is doing, and how they look to improving the performance of their portfolio companies on job quality across the life of the investment. Aureus Capital, in their Africa Health Fund, it was one of the funds that was featured in that Gene piece that I shared from 2011. There you would have a 15% base carry, First target would be a 5% increase that brings you to 20. And if you reach either B or C, you will get up to a 30%. I do note that this is based on outputs, not outcomes. So this the way that Oreos was set up, the carry was tied to targeting a particular population through their services. So ensuring, in this case, I think that a certain percentage of the recipients of the services were below a certain income level. And lastly, the core innovation capital that was also in that Gene issue brief. In their case, it's an annual bonus to the fund manager, to the GP, and only 10% of the carry was tied to the impact. So in this case, using what was disclosed in that issue brief, even if the impact score of the portfolio at the time of the liquidation event was 70%, so they've reached 70% of the 100% possible impact, the GP would still get 19.4% of the carry, right? Only the last 10% would be impacted by it. So a couple of things that we should look at throughout this call are who drives this kind of effort, and it can be both on the part of the GP or of the fund manager in order to demonstrate ex ante their commitment to the mission of the fund, or it can be driven by the LPs themselves that want to ensure the alignment. And as far as I've seen so far, there is still not an industry standard or a best practice around this. That is to say, we have not seen a consistent effort on the part of LPs to ask this kind of tying of their fund managers. I will mention briefly, we have been in conversation with B Labs and B Analytics around looking at the data that they have on the various structures that have been used and trying to see if we can derive a series of best practices from that. The other issue is who pays for things, right? This can be a fairly expensive effort to go through. So the two examples that we've seen are a technical assistance facility for the measurement and evaluation that is paid for by the LPs, or it could be made to come out of the management fee to the fund manager. And I'd be happy throughout the course of the call to hear any views on that. Few issues, as always, around this, or from our Transform Finance perspective, who gets to define that impact? To the extent that we've seen it, it is generally a matter of either the LPs or the GP defining what that impact should be, not necessarily the affected community or the ultimate ostensible beneficiaries. There are some considerations around how you measure this impact across time, right? Whether it's you stop at the time of liquidation or of a liquidity event, or if you are taking into account, as we'll see in the MDIF presentation, the exit itself as part of that impact or non-impact. So you might have very good impact performance throughout the life of your investment, but if upon exit you lose all those benefits, then that should be part of the consideration. And the last, which also we'll look at in terms of the timing of when that determination is made, whether it's halfway through the life of the fund or upon a liquidation event, will be if you can have some misaligned incentives to sort of front load some of the impact that then gets diluted, losing some upon the exit, etc. And Harlan and Evan will go more into it. So I will turn it over to them. Again, I'm absolutely delighted that they can join us for this and tell us a little bit about how they've been looking at the impact throughout their various portfolios and how they're thinking of it in this equity context. Specifically, MDIF has been a supporter and also a member of the Transform Finance Investor Network from the get-go. So I'm really delighted to have them here. So Harlan and Evan, you should be unmuted. Thank you for joining us.
Great, thank you, Andrea. Can you hear me all right?
Perfect.
Great. My colleague, Evan Kowski, is sitting next to me. We're gonna be switching cameras a little bit So bear with us. And Andrea, thank you for giving us the opportunity to talk about what we've been doing in this area.
There you go.
Thank you. And I guess this webinar grows out of kind of a series of discussions that Andrea and I have been having about how some of these issues that Transform Finance has been focusing on plays out in the media field that we're engaged in. So this seemed to be like one area that would be of interest to other practitioners beyond the media space. And that's how we got here. So if I can, let's see, so I have control over this now. All right, thank you. So Evan and I are gonna take you through these three issues. So first I'm gonna explain what we do, and with a primary focus on our mission, because in the context of trying to create a system of impact metrics, mission is at the base of that. So it's important to have an understanding of that before we can talk about everything else. Once I've done that, I'm going to hand things over to Evan, who's our impact officer, and he's going to explain the way our general practice of assessing and reporting on our impact to our investors. And again, that was the base that we used for developing an impact metric system for the equity fund that we're raising. And then in the last part, I'll explain that system, how we arrived at it and what drives it. And Andrea, correct me if I'm wrong, but you said people should feel free to jump in with questions during the course of the presentation. Is that right?
Absolutely. If that's fine by you, yeah. Anybody who's participating, feel free to unmute yourself and jump in. There is also a flag raising function if you prefer to raise a flag, and there is a chat box at the bottom right that you can use to present a question to the group. So whatever works best.
Great. I'm the CEO of Media Development Investment Fund. We've started in 1995, and our mission is building free, more open societies around the world through the vehicle of independent media companies. So we tackle questions of access to information, freedom of the press, government accountability, and access to voice and information poverty in the way we evaluate projects and try to encourage their development. So we started in 1995. We originally started working in Eastern Europe, the former Yugoslavia. It was not long after the fall of the Berlin Wall. There were a lot of independent media companies starting, kind of being birthed for the first time in those places. And they were all experiencing a lack of access to capital for a variety of reasons. Some, all the same reasons that SMEs all over the world face lack of access to capital, but in this field, because they were often seen as counter to the interests of those in power, they often were unable to access either bank financing or equity financing without strings attached. People who, one way or the other, wanted to exercise some influence over their editorial policy. They were receiving grant support from the international community. At that time, particularly in the former Yugoslavia, the role of media in fomenting the violence in that country was well documented and well understood by the international community. So support of independent media became a big development issue at that point there. But they were providing typical kind of grant support, small things here and there. They were not providing the kind of capital that a company needs to really build and develop a business. And that was why we came into being, to provide. And at the time, it was before there were, there was no impact investment concept. It was before venture philanthropy, mission investing. It was just, we were kind of born as a specific solution to a very specific problem. And the other issue, as soon as we started providing financing, it became clear that these companies needed significant management capacity building as well. And that became our basic model: capital plus management capacity building. And it pretty soon became apparent that this problem exists in many other parts of the world. And within a few years, we were working in Southeast Asia, in Africa, and Latin America. To give you a sense of the kind of companies, and I think really to communicate our mission, the best thing is to give you some sense of the companies that we seek to provide financing for. So one of our fundamental requirements is independent ownership. So that means no government ownership, no political party ownership, no oligarch business interest ownership. In Latin America, we're deeply concerned with narco trafficker ownership. We look very deeply at the ownership of these companies before we start to work with them. Most of them are, in fact, owned and managed by journalists who founded these companies and are very mission-driven folks, and that's the reason why they started these businesses. And it helps provide some significant assurance around continued mission traction. Most of our clients are very well known, at least locally. They're typically the most respected sources of independent news and information in their either country or local community. And we're looking for companies that have projects to finance that are going to change their economic potential and really drive some growth and greater sustainability for these companies. So let me give you 3 examples so you can get a sense of what we're talking about. So Buyout 90 is a radio broadcaster and network in Nepal. So it's based in Kathmandu. It owns and operates 3 stations in the 3 largest cities in Nepal. But then it provides news and other kinds of programming to over 150 radio stations across Nepal. Some of them city radio stations, all the way down to community radio station level. And we were involved with them from the very beginning on a technical side, where we helped them with the system for transferring their programming to all these stations through a satellite system that we had, another client of ours had pioneered in Indonesia. We brought it here to Nepal. And then more recently, we financed construction of a building for them. To give you a sense of these folks, so a number of years ago, there was the royal family in Nepal was assassinated, martial law was declared, and radio stations were told they can only broadcast music, as a way to kind of controlling them from reporting news. So these folks, got on the air and they sang the news to their listeners as a way of meeting that situation. I think it gives you a sense of their creativity and their commitment to what they do and the risks that they're willing to take when necessary. You all know recently there were massive earthquakes in Nepal. So the building we financed there was, thanks to the forethinking of the people who run this company, the building was earthquake proof and solar powered. So when the earthquake hit, Ujala was the only national broadcaster left operating, the only private broadcaster left operating. And they played a really critical role in the disaster relief. Many other stations carried their signal, even members who were not members of their network. And the government closely worked with Ujala to get emergency messaging across. And they had journalists all over the country reporting from the hardest hit disaster areas. This is another company, Malaysia Kini, So that was Broadcaster. This is a digital media company, a digital native. Malaysia Kini started in 1999. In Malaysia at the time, and still today, all print media and all broadcast media is fairly controlled. The government had made a pledge not to censor the internet. These folks decided to take them up on that. And they launched really the first locally based independent news outlet in the country, only online. Today, it is the #1 online news site in the country. They have 2.5 million unique readers on a regular basis. Their content, they have actually 4 sites, one in English, Chinese, Malay, and Tamil. They have been really at the forefront of whatever kind of democratic change has been happening in that country over the past decade. For many years, they were the only news source, local news source, covering this democracy movement that was developing in the country. So to give you a sense of their importance during the last election, that 1 out of every 4 Malaysians with internet access were on Malaysia Kini's site to follow the election results. They were serving 500,000 page views a minute that night. This is a very different kind of project, Collaborate in Brazil. So with the advent of digital media, we expanded our mission framework to look beyond just classic journalism as for other kinds of technology companies that can meet our mission around government accountability, promoting public debate, and citizen participation. So Collaborate is a social network that lets citizens register complaints and ask for action from local governments. And essentially there's an app that people can use to report these complaints and also to create kind of citizen campaigns around specific issues that they want addressed. Everything from broken traffic lights to much larger urban issues. The business model is actually the governments are subscribers to a variety of data analysis tools that help them track where these complaints are coming from and how they can be addressed. And there's a free version for any government, and then there's a paid version with much richer applications. For us, the key thing is the data does not belong to the governments. The data is open to the public, everybody, which allows the public to hold governments accountable for what's happening and to see what other people are concerned about. So as you can see from these examples, we're very concerned with government accountability, and we're looking for companies that are addressing that through news reporting. And also, we're very concerned with citizen participation. And all of these, including the Radio Ujala in Nepal and Malaysia Kini in Malaysia, are big encouragers of debate, either through talk shows on the radio or through comments on the website. This chart gives you a sense of the spread of our clients and the companies we work with. So the vertical axis is GMP per capita of a given country. The horizontal axis is ratings from Freedom House on press freedom. So Freedom House is an NGO. Each year they rate every country in the world on the quality of press freedom in that country. These circles represent countries, and the bigger the circle, the larger our investment in that given country. So you can see we're currently invested in a little over 30 countries. And the chart is interesting in if there's a trend line, it would go from the top left to the bottom right, which shows what is a kind of a well-known correlation between economic success and press freedom, which is a feature of economic development that the World Bank has done a lot of studies around. So I always like to point this out because I think it's interesting. If you look at the big circle in the upper right corner, so this is a relatively wealthy, very evil country. That's Russia. If you look at the bottom right corner, that large circle is that very, very poor, very evil country is Zimbabwe. So just quickly to give you a sense of our track record, and I should say to start off with, we're actually a nonprofit, so we're registered as a New York nonprofit corporation. We have public charity status, so we're a 501c3. And to date, we've operated as we have a revolving pool of funds that sits on our balance sheet, and we use that to make both debt, provide debt financing, and also to make equity investments. So our current portfolio is about $42 million, roughly, 1/3 is in equity investments, 2/3 in debt. So to date, or at least through the end of 2014, we'd provided a little over $116 million in debt and equity financing to 108 media companies in 38 countries. So of that $116 million, we've recovered a little over $62 million in principal, so repayments or equity exits, while earning about $40 million in returns, interest, dividends, and a large part of that is capital gains from a number of equity exits. As I said, we have about $42 million outstanding. Of the 116 that we put out there, we've had to write off about a little under 8%. So that gives you a sense of our track record. I'll talk a little later about how we got to raise an equity fund and how we started to wrestle with this question of tying impact to fund performance. But now I'm going to pass things over to Evan, and he's going to dive much more deeply into how we talk about impact.
Hello, everyone. It's Evan Tosky, and I am the Impact Officer at MDIF. So it's my role in the organization essentially to look at all of the work we're doing and determine sort of what our impact is on the companies that we work with, and then also their impact on societies. So when we think of this whole big mess of stuff going on, we have outputs. We invest in clients. We ensure that those clients meet our qualified beneficiary criteria, which is a more formalized definition of what Harlan described earlier. With these clients are independent voices. These clients are hopefully either journalist owned, or there's independence between the editorial side and the management side. All these sorts of things that we think make up a good client. We've seen proven over time that make sort of high impact media company. That goes into our qualified beneficiary criteria, and so then we would make an investment or make a loan. And so the first area we're interested in there is to what extent do our investment, do our support actually move the dial on client sustainability? So are we actually helping companies in these sort of high risk or moderate risk environments become sustainable businesses? Are they surviving? Are they growing? Are they thriving? And that's really sort of the key question for us, because it's what we have control over. It's our decision making that we select the client, and then it's our work, our sort of technical assistance and investment, of course, that actually is doing something with the client. It's actually changing something. The second level, of course, we really are interested because at the end of the day, it's the clients doing this work in societies and hopefully improving societies that we care deeply about, and we're interested in that level. But we have less control over it, since our clients are the ones doing the work. We don't, step in on their editorial line or anything like that. We trust them to do the sort of best business work possible. But we want to know, for our own purposes, for our investors' purposes, for sort of public purposes, whether those companies are actually having an impact on their societies, and sort of what that impact is. Is it attributable? Did they contribute to something? And ultimately, are there any lessons that we can learn for our future investments to kind of understand the role of media in society? The output of all of that are basically two products. We publish an annual impact dashboard that sort of sums up our finding for the year. This is a public report. And then we have deep dive studies. So obviously, countries, media companies are very diverse, and you can't always tell every story through one single dashboard. And so we go and do sort of in-depth reporting, hopefully on the annual level on a couple of selected clients. To dig a little deeper on that first area, so when we talk about client sustainability, we're really interested in three main things. The first is client reach. So we're interested in that one as a business sort of issue. So media companies are definitely able to sell ads depending on what their audience is, how many people they're reaching, the demographics of that, and then also as an impact issue. We want to know, does the client actually have the sort of societal reach? Are they, people listening to them? Are people reading them? And is that actually translating? And so for that, we look at, how client reach changes after 1 year and then also after 5 years. And that sort of differs from client to client. So as Harlan mentioned, we have a radio station, absolutely massive reach because radio is the primary medium in that society. And we take that as their sort of standard total audience. It's a little different for digital. So for online, we're looking at, how many monthly uniques are they getting on their website? And then, for print, we look at circulation and essentially, how many they're reaching. We total that up for each of our clients. The second area is sales. So of course, vital to the survival of any business. And we want to know, are they actually increasing their sales after our involvement starts? And so we use our close involvement with our clients and their business records and all that data we pull together to evaluate whether their sales are improving, where there might be weakness, one publication versus another, something like that. And we roll that up into the indicator of sales. And finally, we looked at whether they're viable businesses, and we use a risk rating metric that we've produced internally, and then it's sort of audited every year. So it is audited every year by our auditors. And this is both, a tool that we use internally to look at the risk of our portfolio and to see how that's sort of allocated, and then also to look at the health of the businesses. So we look at in there, the management decisions that our companies are making. Are they improving? Are there issues there that we need to work on? They're reporting to us, the quality of that reporting, the sort of structural factors, in the market, in their country. What's the situation there? And overall, we want to see clients that are either maintaining or improving that risk rating, and then hopefully on the long run, they're actually improving their risk rating. Obviously, this one's subject to some of the factors in society. So we work in countries that could be often quite harsh on independent media businesses, and part of that, this risk rating is taking that into account when we consider sort of if we're having any impact on their sustainability. So that second level is where we've recently been doing a lot of work, and trying to figure out when you're working with over 100 companies over our history in 38 countries, as different as Russia to Somalia, to Serbia. What does it actually mean for media companies to have an impact on society? And basically, what we've driven that down to is three areas. First is corruption and accountability, and the second is the reliable information, sort of information people can use to make decisions. The third is whether they're inspiring democratic participation. And to make these things actually sort of measurable, we go through a series of steps. So we first look at what are the outcomes we're trying to do, and then a series of indicators. And not all indicators apply to every client, but we try to stick within these lanes and stick within this framework so that to the extent possible, we can combine these findings across our portfolio. And so for corruption accountability, we're interested broadly, has our client exposed a corruption scandal? Have they brought information to light that wouldn't have otherwise been brought to light that holds people accountable? Second, are they reporting on government policy commitments or promises? And, so this is to the extent that there is some sort of democratic process in the country, to the extent that politicians are running for elections, making promises, to the extent bureaucrats are kind of going out and actually doing work, is our client actually holding them to account on those issues and making sure that their record is as transparent as possible? When we evaluate that, we're interested pretty generally, and we can look through our clients' records, look through their publishing records, what they put online, and we can actually pull out these stories, these unique stories where they may have reported something otherwise wouldn't have come to light, where they're actually doing the accountability reporting we want. The second area, reliable information. We're interested in whether clients give citizens information that they need to really make decisions. They need to participate in the economic life of their country, the political life of their country. All these sort of catalytic things that we know from research that media does. And really, there we're interested in sort of broadly, what does the audience think about the client? So are they considered valued? And then what public policies, what sort of complex or otherwise inaccessible public policies or economic processes in a country does the client actually make intelligible for the clients? And then the third area we have is democratic participation. So for us, that means that the outlets we work with are fostering debate in their societies. They're fostering discussion. And then secondly, that means that they're motivating citizens to participate in the public life of their country. So they're not just saying, you know, well, here's the article, comment on it. We're actually looking for the type of impact where these media companies are encouraging people to participate. What participation means is very different from country to country, and is obviously limited by the laws of the country. But you know, we want, for the discussion, we want people to have discussed a report with friends and family. We want these articles that our clients are producing to be sort of the fodder for debate, the fodder for, you know, these disagreements that form the sort of active life of democracy and hopefully the future of the country. And then second, had they actually taken action? And so this is sort of a big hurdle, right? Because, you know, we all take in a lot of media, we all learn a lot of things, different people, and to actually have taken action on the story, to, you know, to actually have, you know, attended a protest, to written a letter, to do any tangible thing is a real big hurdle, and something we would hopefully be interested in seeing with our clients. As you can imagine, you know, we have, you know, roughly about 30 to 40 clients at any one time, and measuring all this stuff for all those clients in all those countries is a very resource intensive process. And so we're in the process of figuring out how we can do that sort of affordably and in the amount of time possible. And essentially, I'm going to run through this pretty quickly because it's something that we're actually working on right now. It's not fully developed, but at the first level, we're interested in essentially, you know, researchers or elite individuals in society who would be positioned to make the determination that a story was actually unique and that story wouldn't have been reported otherwise. At the reliable sort of information level, we really want to take it to the audiences, and we want to, you know, to the extent possible, get a sense of what they're thinking, what they know, how they value. And then to democratic participation, the same thing. We're actually surveying audiences. We're working on audiences in focus groups or in data. And then to make it sort of expedient for us, we've divided this into 3 tiers of countries. First is our data-rich environments. Those are areas where there's actually either public data available or there are good research companies that we can partner with to get at the data. The data-poor environments are countries where, you know, putting a survey in the field is hundreds of thousands of dollars, and it'd be very cost prohibitive. We have sort of other smaller bore strategies for that. And third, the politically sensitive context. Those are environments where we couldn't even put a survey in the field if we wanted to. It's just so sensitive. And so we kind of try to balance all those things on this matrix and find the right strategy to access those 3 areas. The next thing is, you know, sort of the process of how we brought what we do on the sort of sustainability side, added the impact, and then how we transition that into what Harlan's going to talk about today, which is using that framework as a part of a broader structure to tie our carry to impact. So this whole framework, this whole debate about you know, what impact media has, what impact our clients have in their societies, we started working with some students at Columbia a few years back. And we piloted that framework with our clients in Guatemala. Then we really did some heavy tweaks on it and adapted one portion of it for our dashboard. So if you pick up our dashboard, we have the corruption and accountability section on there. And then to really, really, you know, focus in on what we could do with this to make it actually useful for the equity fund, we had some assistance from the Dune Foundation and a consultant that they networked with us named Stuart Red Queen. And they helped us really drill down further and make this sort of, these 3 areas part of our process. And then hopefully we're piloting some of this methodology later this year. And Harlan will describe exactly how it fits in the process of the equity fund.
So in this case, Evan, it was from the research element initially that that the idea of tying the impact to the fund returns was born.
Exactly. Yeah. So for us, obviously, you know, this is sort of the holy grail if you work anywhere near media, is, you know, actually understanding what impact you have on societies. And it was something that we wanted to build into both our standing framework, so when we work with our general fund, and then also to the equity fund. And so it started with this research process, and then, you know, tools don't always work perfectly for the purpose, and so we needed to really refine it. And Harlan will talk about how we kind of process that and put it into one portion of the equity fund equation. And yeah, so those are basically the two lines where we had this going towards our general fund and then also splitting it off and making it valuable for our equity fund.
Thank you.
Sure.
All right.
Sorry about our technical difficulties. Can you hear me all right?
Yes.
All right, and now I can hear you. So I guess we get to the main part of the show now. So we decided that it made sense for us to try to raise a private equity fund, which was a very new thing for us. It's a different way of raising money, a different relationship with investors. Our motivation was, there are a number of motivations for it, but the chief one was properly aligning the interests of the investors with the investments we were making. So to date, we manage a hybrid fund on our balance sheet, and that has been funded through a mix of philanthropic capital, grants that come to us, and then we lever that up with loans from our investors. So with the equity fund, we're taking a different approach, creating a fund that's all the investors know all of the funds are going into making equity investments, and they have a potential to participate in the upside. This fund is intended to focus on broadcast media and digital media, primarily in Africa, Asia, Latin America. We're looking, targeting $50 million for the fund with a first close of 25 to 30. And we have two anchor investors that have been very involved in the development of the fund concept with us. And that's the Dewin Foundation that Evan mentioned, and the Open Society Foundations. Both are longtime investors in our existing fund. So when we started talking about this with the Dewin Foundation, they challenged us to tie the carry, and the structure of this fund is very kind of classic private equity model. So it's limited partnership. There's a 2.75% management fee, and there's potential for us to participate in the returns through a 20% carry. With a 5% hurdle rate. So the folks at the Dewin Foundation challenged us to tie the carry to our impact. When they raised that with us, we honestly embraced it, because we thought, well, this is easy. This is what we're about. We're totally mission first impact fund. Let's see how we can do this. And what we wanted to do was kind of take our existing process and all of the elements that tie into mission, and try to incorporate that into a system that assesses the impact that this fund is going to have. So let me start with an overview. And we're thinking, so first of all, I should say, as Evan noted, sustainability is one of the first tests of impact for us. Are we helping these companies become sustainable? That issue is not incorporated into this impact metric system. And that's because there's an assumption that if we're exiting with at least a 5% IRR, it assumes the company's done well. We sufficiently moved the dial on its sustainability during the time that we're invested. So
I would add to that, Harlan, maybe by way of a question, it would almost amount to double counting, right? If the sustainability of the company, which is part of your passing the hurdle, was also counted as part of the impact on the percentage of carry, correct?
I think that's a fair way of thinking about it. So these metrics are focused on the mission impact, and particularly the impact that these companies are going to have over time in their given societies. So we, as Evan mentioned, the June Foundation set us up with some Stuart Red Queen, which is a Dutch consulting firm that specializes in impact analysis. And that was actually very helpful for us. We had our framework, but they helped us contextualize it in a way that is a little bit more structured. So they helped us break the impact down to these three groups. So 1, directional impact; 2, the ongoing impact; and 3, the question of sustainability of the impact. And they made the point to us that most of the research has shown that the directional impact is the most critical. So the decision that's made up front about who you're providing the financing to is ultimately the biggest factor in ultimately achieving impact. In a way, it makes sense. If you don't start with the right folks, the chances that you're going to actually achieve what you want is pretty limited. So we've broken the directional impact into 2 pieces. And you'll see on this chart, there are basically 5 kinds of impact that are being assessed over the life of the investment. Each one qualifies for 20% of the carry, so 20% of the 20%. And I'll break that down a little bit more deeply. But so in terms of directional impact, there are 2 elements. The first is we were looking at for an objective, at least a third-party view of whether this is a country where our assistance actually is called for. And this is a standard part of our, and I should say, the way our typical project approval process and client approval process works is we have 2 stages. The first step is carried out by our board of directors, and it's focused completely on the quality and the impact of the company's journalism and its a track record for editorial independence, and the independence of its ownership. And they always are first looking at whether this question about country fit as a threshold issue. So we call this our kind of threshold mission screen. It's carried out by our board of directors. Our board of directors, it's a volunteer board. Nobody's compensated. It's made up of a group of experts in independent media, human rights, and international development, with some investment expertise mixed in. And they have this, I'd say, quite strong track record of choosing companies that are going to have significant mission impact in this area. So that's, though, in a way, it's not a third-party analysis. It's by our board, independent though they are. So we were looking for a third-party check, and that's Freedom House's press freedom rankings. And we need to be investing in a country that is somewhere between partly free and not free. So not working in countries that already have an established free media. The second, as I said, is our board certification of mission fit. I'll go through that in a little bit more detail. The third element, looking at the ongoing impact of the company, we looked at two kinds of impact, or two assessments of impact. So one, again, is an objective metric, and this is what Evan had spoken about, which is reach. So we for a long time, we've been tracking the change in reach of our clients. It's something, as Evan said, there are third parties out there who are providing that data either through audience ratings or website audience numbers or readership numbers. And I'd say now that we get to the trickiest part, which is the impact evaluation. Again, Evan spoke about that. And this is something that we're carrying out either through third-party evaluators or using third-party measures. And again, I'll explain that in more detail. And then the final element is around the exit. Have we achieved a sustainable exit? So that's the overview. So I want to take each one of these and drill down a little bit more deeply. So mission fit, in principle, what our board looks for is for us to work in a country, there needs to be a history of media oppression or of media ownership concentration. The countries are in the process of going through some kind of democratic transition, or the country is suffering from some kind of information poverty, which is really a fundamental development issue. To assess that, we've been using, as I said, Freedom House's Freedom of the Press rating, and this is really a binary test. It's either free, in which case we get no points for working there, or it's partly free or not free, and then we get the full 20% of the carry.
One quick thing on this, Harlan.
Yes.
So there would be context again as we're thinking of how this would affect the whole carry, where you might want to invest in a free country and forgo this 20% of your 20% because of other considerations regarding the remaining 80% of impact.
So I'd say it's theoretically possible,
but not your focus. Okay,
but not likely.
Yeah.
So the next piece, which is mission fit. So we have an established set of criteria for beneficiaries of our investments, and there's a whole slew of criteria. I've highlighted the main mission elements of that, and that's that the content is unique, credible, independently produced, that it's either providing news, high quality news, or opinion that informs public debate, or that provides a platform for public debate. We're aiming to foster pluralism, so there should be a variety of views presented. And as I said earlier, the ownership has to be independent. And again, this is a binary test. Either our board has certified that the criteria are met, or it hasn't. And the reality is we would not be investing in anything that our board doesn't pass our board's muster. But this is in a way an extra element of guaranteeing that. Reach is something where I think can be a continuum of success around. So the idea here is we're going to be at the beginning of the investment, we're going to be setting a target for the expanded reach of a given company. And at the end of the day, we're going to see how much its reach has expanded over the life of the investment. So if it reaches 70% or more of the target, then we get this full piece of the carry. If it's a kind of middling success between 50 and 70%, then we would get 75% of this piece. And if it's below 50%, we don't get any of this 20% of the carry. And now we come to the impact evaluation. And in a way, this is the trickiest part, because in doing this, we're going to want to look for a methodology that is most cost effective, because the cost of this is being borne by the fund, in a sense, by the LPs. So we are assuming we're going to be working closely with the LP advisory committee in defining for each investment what is the most cost-effective, most appropriate way of assessing its impact. And I should say we're going to be assessing impact along these lines over the life of the investment, as we do with all our investments, and we'll be reporting to investors how things are going and what we're seeing. But we want to be able to, at the end of the investment, make an assessment of what's been achieved over the life of the investment. So the key issues, as Evan has said, that we're looking at are, to what extent has this company held those in power accountable? Have they been providing reliable information about events that really affect citizens? Have they been promoting and deepening democratic participation? So there are a few different ways that we see approaching this. So one is external validation. So for example, we have a lot of clients, they typically will win most of the journalism awards in a given country. And there are a variety of let's say, third-party assessors of quality and which we think translates into impact, which is a very cost-effective, easy way for LPs to determine that this impact metric has been met. In places where that's not available, then the next step we would go to is a qualitative evaluation, which again, Evan has talked about, which is largely going through some kind of a polling mechanism. There are a variety of ways of doing that depending on the country, but using a system of polling to examine these questions about a given news outlet. Where that's not practical, then we would be engaging a third-party expert to do an analysis. We're in kind of a typical evaluation of a company's impact. Typically, that would be a political scientist that we would be looking to do that. And we would be working with the LP advisory committee to, they would have a right to approve who that evaluator is.
And to go back to the earlier point on that,
so,
Harlan, can you share who would be bearing the cost of that? Is that established upfront?
So again, that's a cost that's borne by the fund.
Okay.
So again, this is one of the metrics where there's a range of possible levels of success. So we've broken it out into these three categories: high impact, moderate impact, and no impact. And the level of carry that we earn is based on which of those levels we achieve. High, we would receive all of this piece of the carry. Moderate, we would receive half, and no impact, we would hit zero. And this is based on how many of these areas we've the client has proven out on, right? So accountability, reliability of information, democratic participation. So if it scores well in 2 out of 3 of these, then that's considered full success. The last piece is the question of sustainable exit. And it's, Andrea and I have had, some really long, deep conversations about this question about what, how, and I should say we've also had similar conversations with the Dewin Foundation. And internally, we've wrestled with this a lot. So if we've been invested in it for 10 years, it made an incredible impact on their country during the course of those 10 years. What happens if the exit is not a good one? And I'll talk a little bit about what that means. So it's and I think in the course of the conversations we've reached a sense of acknowledgement that it's not the most important thing, but it's still important. What happens once we've exited the company, not just what's happening during the life of the investment. So the way we think about sustainable exit, questions are, when we leave the ownership, is the new ownership or the ownership that's left behind such that it's likely to continue maintaining the company's editorial quality and editorial independence and commitment to mission. So we see a variety of ways of achieving what we'll call a sustainable exit. So one is IPO. We consider that sustainable because IPOs leave the company in the control of the management, which for us is defined as the folks who have been driving the mission of this company since our involvement. Second is a management buyout, which is has a similar effect. Andrea, did you want to say something?
Oh yeah, just a quick question. If you could expand a little bit more on that. And I did find it fascinating when we talked about it, about the dual share structures, because in the field in general, many people view an IPO, as a potential loss of mission. And it seems to me that you've come up with a fairly elegant way of saying, no, the IPO can actually perpetuate that mission in this way. If you could tell us a little bit more about that, because I want to start thinking about whether that is something that is specific to the media context, or it can be applicable to other sectors as well. The IPO can actually be a way of entrenching the mission.
So, well, this is the way we've been thinking about it. I should say we have not had the experience of an IPO in any of our exits, so it's theoretical at this point, I would say. But first of all, the companies that we invest in, the way we think about it is we only invest in companies where their competitive advantage is the audience trust in the reliability of their information. And that's what distinguishes them from their competition. And that's nice because there's complete alignment in a way then with mission and the financial interests, long-term financial interests of the company. And I say that long-term because in the short term, there are certainly plenty of challenges that come with sticking to that mission. Advertising boycotts, certain relationships with advertisers are fraught, and you really need to keep your eye on the long-term mission and the importance of that trust relationship with your audience. And I think our clients have really shown that they're willing to do that and able to do that. But for that reason, again, the management of the company and the management that we work with has a track record of maintaining the editorial independence and the mission of these companies. And in an IPO, while there's theoretically the possibility that somebody could come in and sweep up a lot of shares and take control of the companies in a hostile takeover, at the point that we're doing an IPO, that's certainly not the assumption of what's going to happen moving forward. The assumption is that the management, the people who we've been working with all during the life of the investment, are going to maintain control of the company. Typically, there are. Let me circle back, Andrea, to talk about various structures that can help ensure that, because I think it applies in other situations even more strongly. Which I'm coming to right now, which is a sale to an investor. So this is a case where there is a sale of a majority stake to a new owner. When it's a sale of a minority stake, it's not quite as much of a concern, right? Because again, the owner management is staying in control of the company through their majority stake. But where we're passing majority control to another company or another owner, then it really raises a significant question for us about the continued mission of the company. So I think there's one class of owners that we feel confident in, and that is existing companies that are already in the news business, the information business, that already have an established record themselves of being concerned about editorial quality. But even in that case, and going beyond that to investors who are more not strategic investors in that sense, we've seen different ways of trying to ensure the continued editorial independence of the company. One is by most of these companies already have a set of principles around editorial independence that they operate around, and there are various ways of kind of tying the future life of the company to those editorial principles, either by providing a golden vote around these issues to the founders, different share classes. So there are a number of cases throughout the world, including the New York Times, where the founders have a class of shares that have control over various features of the business, including the editorial direction of the company. We've looked at structures where the founders will at least have a put option, which gets triggered if the editorial independence of the company is messed around with. So there are a variety of mechanisms that we've seen for doing this. And if we're going to be exiting to a new majority owner, building in those mechanisms for the future life of the company would be critical for us to be able to characterize this as a sustainable exit. At the end of the day, it's going to be the LP advisory committee that is making the determination whether it's a sustainable exit or not. And again, it's a binary test. It's either sustainable or it's not. We either get this part of the carry or we don't. The way this all wraps up together. So Andrea, did I cover enough ground on that point for you? We're frozen. You there still, Andrea?
It was terrific for me. If anybody has questions, feel free to put them in, but I thought it was tremendous. I see a note popping up.
Oh, thank you.
Yes, you're good.
So then just to wrap this up, so we're at an hour, well, rather than go through this slide, it simply kind of breaks out a couple of different scenarios for how these different impact elements can add up to either a full carry or a partial carry. I think it's kind of obvious. So rather than spend time on this, it might be better to open the floor to questions. Do you agree, Andrea?
Yes, and anybody on the call, yeah, feel free to unmute yourselves or use the group chat if you're using the app, if you'd like to ask a question.
This is
Rebecca?
Morgan. Sorry. Oh, sorry.
Hey, Morgan.
Hi, Morgan.
Oh, sorry. I thought you were referencing a Rebecca. Sorry for some of the background noise. Always great to hear the great work you guys are doing. I was actually curious. You mentioned that some of this work came about with the Doan Foundation bringing the idea forward, and I'm curious, is this something that they've now implemented as kind of standard in the funds that they try to invest in? Did you get a sense of, was this kind of a first pilot for them too, or is it becoming more standard practice?
It's a interesting question. So I know this is the first time that they've done this with a fund that I'm aware of. I don't. Is there anybody from Doan on the line? That might be okay. So I don't know, honestly, whether they've been pursuing this with other funds. I know they're very excited by it. It's not clear whether they want to get a sense of how this works moving forward before putting it into other funds or what. But I will be very happy to put you in touch with somebody there, Morgan, and you can ask them.
Sure. And then the other, and I apologize if this is a pointed question, but I know we're all amongst friends here. I imagine that in negotiating the criteria, there's kind of an interesting question around a number of those factors. I imagine, so for example, like the country selection, you would say, this is really what we would have done anyway, because this is the core of our mission. So therefore, we're not too concerned about having these criteria attached to our carry, because of course this is what we're going to do. And then I imagine there might be other pieces where in the back of your mind going, well, this might be more of a stretch goal, and I'm really going to have to work, harder or differently to make sure I achieve that one. I'm curious sort of your thoughts on like how you balance the, how hard do you set the goalpost?
So, I would say that for us to be working towards these, the truth is we don't change the way we work at all to do this. This is, and that was very intentional, right? So we really see ourselves as a mission first fund, and every part of our investment process is aimed at that. We're very serious about getting a return on our investment, a financial return as well, but all of our systems and processes are geared around ensuring that we're maximizing the mission impact of what we're doing. So, in crafting this system, we very much were taking our existing processes and kind of grafting them into a system that at least will, in a sense, hold us accountable for what we say we're going to do and say what we've been doing for the LPs. The question that you posed around having particularly the first two impact metrics, in a sense, being easy for us to achieve, right? Because we would not invest in a country if those two things were not met. It's true, and we did have some discussion around that with Doing. I think there's two pieces to that. So one, through Queen, again, at this point, this is exactly where the most impact is going to be had. So and our existing system for assessing it is quite strong. So it is an appropriate base for that. But I think there's another way of looking at this, which is and in a way, it also played out with a sustainable exit metric on the other end. How big should that be, right? And I think from an LP's perspective, it's important that all of the carry not be tied to mission. I mean, or I shouldn't say not be tied to mission, but at the end of the day, if we're at the point of exiting an investment, it's not in the interest of the LPs for us to have no possibility of earning any carry, even if that company has moved off of mission, right? So because in a way we won't be motivated to find a good exit. The LPs still want to have a financial return, even if the mission return hasn't been achieved. So that was part of the conversation that we had. So in a way, the directional impact elements, which are set up in a way, we've earned that from the day, assuming that we're ultimately able to get the financial return of over a 5% IRR. We've earned our part of the carry at the time that we've made the investment. But it's ensuring that we're not investing in companies that don't meet our mission, which I think, from the point of view of many impact investors, I think the experience with a lot of funds is that's actually a deep concern.
Yeah, that's true. And I love that it sounds like it helps you have those conversations in a really kind of long-term accountable way.
There's a chat message
And
from
I would
here. Do you see that, Andre? I'm not sure if that's somebody or not.
Sorry, say that again. I didn't hear the last part.
There, in the group chat, there's something from Laura Ortiz.
Oh, let me see. Oh, yeah, it was a yes to your earlier question, I believe, around whether the explanation was.
Oh, okay. Thank you.
I'll throw a question back at Morgan or any of the other LPs that are on the call. Is this something that you're paying more attention to now? Do you see this kind of structure coming more often? Is it a potential investment in a fund?
And this is Morgan. There's a fund that we're looking at right now called GAWA that does financial inclusion in emerging markets. And we in general have been a bit gun shy around financial inclusion because we felt like a lot of the impact evidence was very spotty. And in this case, it's a team that's been extremely thoughtful around impact measurement and management to the point where they do intake a very thorough, the Thesis methodology, which is like 400 questions and multiple hours in the intake. And then they have 25 factors that they look at on a quarterly basis, and that gives them a score from 0 to 1. And then their carry, at the end of the day, the investment committee gets to choose a third-party monitor who will do a final audit. And depending on what they get on that score, you know, if it's 0.69 or 0.75, that's multiplied by the carry, and that's the percentage of the allocation that they ultimately get. So it's a way of really keeping them honest and driven towards a specific set of indicators over time. But it also serves the function of kind of helping them try to bring the best players in from the beginning, right, so that there's less of a delta to have to achieve. I think others know we've done a fair amount of work with groups like Huntington Capital to get them to improve their impact management methodology. I'll note that in those cases where it's not tied to a carry allocation, you are really working on good faith. And I think, you know, in a newly emerging industry, reputation goes a decently long way, but how far that goes, and also when we're talking about funds with a 10-year lifetime, I think what maybe is exciting and different about tying it to carry is that it really is kind of insurance against mission drift. And then the final thing, I think part of what Harlan was saying, it really, I think, gives you this good moment with the team of seeing, well, how much is this rhetoric and how much is this so integrated with the business that, of course, they'd agree with it, because why would they do anything else, right? That if you're getting pushback at that stage, that's an interesting moment of testing the alignment of vision. So I think it's something that we're, you know, definitely supportive of in cases where it makes sense for management teams and the way that that sets culture for organizations. I haven't really heard of that many others doing it, so I am curious, as Andrea said, if there's others on the call who have some experience.
Great. Yeah, and speaking of, either here on the call or feel free to send me a note offline also if you have seen other instances that you think would be interesting to analyze in this context. Thanks, Morgan. I'm not sure if I've frozen up. One last thing that I was going to throw out there, assuming that, that you're still hearing me, was around this idea of, what a fund can do with respect to the portion of the carry that is not allocated, yes. because one has not reached, let's say, that full 100%, which
So this was a really interesting point that Andrea raised with us. So up to now, we had been assuming that, you know, if there's part of the carry that we don't earn, it stays with the LPs. But Andrea was suggesting we might want to think about something different, which we have not taken up yet with Ewan Foundation. But I think it's a really interesting idea, which is that rather than that piece of the carry that we don't earn going with the LPs, that it be donated to another organization, to a nonprofit that's dedicated to press freedom or something else in the same space. And I think it's a really interesting idea. For one thing, it then turns this question of whether we're earning the carry or not. There's no, the LPs who are evaluating it don't have an interest in, in self-interest in determining whether or not we've met the carry or not. And it also preserves the carry for continuation. It rolls back into the mission. It may not be us, but at least it's somebody else who's supporting press freedom or access to information out in the world.
Yeah, it's like a hedge essentially for the mission piece. Yeah.
So I love that idea. I'm going to be testing that.
Very cool. Anything anything else from anyone else? Oh, good.
This is Morgan. I feel like, I think you guys have been great and thoughtful about, you were asked on this call to talk about a specific piece of methodology and not, specifically as a fundraising pitch, but I do feel like maybe just 30 seconds of talking about the equity offering and sort of what you're raising and what your timing is, if that feels appropriate. I mean, up to you. But I imagine that just in case people are curious.
So I'm told by my general counsel there's only so much I can say in a public forum like this. So I would encourage anybody who's interested in learning more, just please let me know, and I'd love to share more information with anyone. But in general, we are, as I said, we're aiming to raise a $50 million fund. We're looking at a net IRR for investors of 10.5%. It's a very typical private equity fund structure, as I said, 10-year life with possibility of extensions. And it is, you all now have a sense of the mission impact and how the decisions around investment are going to be made. As I said earlier, it's focused on digital and broadcast media. We think that that's where the critical opportunities are. That there may be some print companies that are making this transition to digital in a strong way, but we're pretty skeptical. So we don't think that's so likely. We're looking at countries where a few key trends are coming together that makes this possible. So that's a movement towards democratic transition, growing consumer economies, which feeds the media business model, and what we call digitalization. So the onset of digital technologies, not just the internet, but also there's a lot going on in digital satellite and other technologies that are creating very new, very powerful opportunities for news, media, and information companies, and often very disruptive opportunities.
Very cool. Thank you so much, Harlan, and thank you, Evan. Let's see, I think we have your contact information there. But again, anybody, please feel free to reach out to me, andrea@transformfinance.org, if you'd like to be put in touch with Harlan or Evan, or learn or share more on this topic. It was spectacularly interesting on my end. Glad to hear all the great work that you're doing, and glad that you could share with this audience.
I'm going to just give I want to thank Evan for helping me do this. He did a great job. And Andrea, thank you again for giving us the opportunity to talk about these issues. And also for all the great feedback you've given us in thinking about this stuff. It's
very important stuff, and I really hope that it spreads out more throughout the field in general. So I appreciate your field building efforts in this area. So, all right, thank you very much, everybody.
Goodbye, everybody.
Take care.